Today, you're going to learn things about how pricing works in a time of crisis. And probably some of you already have a question like, how the heck does he know? Why does he consider himself entitled to, lecture us on how pricing works in regular times and in crisis times? Well, the thing is that I actually started counting the crisis that I went through during my entire life, and it turned out that this is my fifth crisis. So I may tell that I know a thing about crisis. I know a thing or two. And let's start with the demise of the Soviet Union and the first global economic crisis after this one. Well, I cannot tell that I was an economically active subject of a society, but I was around. So I remember these times. I remember how tough they were, and I remember how prices were soaring and other things like this, the shortage of supply and other things I would prefer not to remember, but I do. Then let's get to the next crisis, which is 2008. It was a global meltdown, and actually this was the first time that I thought that I would try myself trading in Forex, and I actually started doing this in 28. And back in 2009, I was the runner-up in a Kiev traders competition. So I managed to increase the account that I was handed by 87% during just 1 month of training. Then it was a Ukraine special crisis in 2014. The world was okay, recovering from the previous one. But in Ukraine, things went pretty tough in business, both in retail and on the manufacturer side. So back then, I was working as a market analyst and pricing analyst in Mars, Ukraine. So I was asked to design an anti-crisis pricing strategy for the business because they were experiencing huge cost push from the exchange rate and the raw materials getting more and more expensive. So the goals were actually twofold. One was to fix the profitability of the business, and the second was to keep the market share unchanged, because market share is something that Mars Ukraine thought it was very important for them at that time. So I started crunching numbers, meaning sales numbers and price changes numbers, and I have designed this pricing strategy that has actually helped Mars Ukraine to hit both targets in 2014. And so the pricing realization, the price execution was so successful that it attracted attention of global and regional guys. So they told me that I need to take part in the global Mars Heroes competition of cases. So I submitted this case, and again, I took the second place in this competition. Now in 2020, I'm here working for Computera, pretty sure that everything will be just grand. Now let's talk about how pricing and other sales drivers work in general, to give you a little bit of context. And we actually operate this triad of business growth drivers, and some companies call it the flywheel of growth. Other companies call them growth engine, but the essence is the same. There are three main things that impact sales of any business, be it a manufacturer, vendor, or a retailer. And these drivers are awareness, meaning the share of the population where you operate, where you try to sell things, that are actually aware about your brand, about your label, about you handling a certain category, etc. And it's typically built by advertising. Well, some companies do it via word of mouth, but the most reliable thing to do to build awareness is actually to run ads, as Mark Zuckerberg said once. So the second one is availability, meaning that you need to have certain goods in place and available for shoppers actually to be able to buy them from you. And this is achieved via building distribution, making sure that you have, well, for offline retail, making sure that you have enough stores in places where the traffic is good enough, intensive enough, or you are placed in some destination shopping mall, etc., where a lot of shoppers actually shop. And the second thing is having the most relevant product on the shelves, so that when shoppers decide to enter your store, they actually have a good choice of between or among the brands that they're used to buying. And finally, it's relevance. And relevance is one of the trickiest things because, well, it means some, airy things that are quite difficult to calculate and to describe in scientific terms. It's all about how relevant shoppers consider your label or your brand in case you're a vendor. And it's composed of a lot of things, but let's talk about them in a bit later stage. So depending on the stage of the business, or depending on the state of the economy, different drivers play a crucial role. So let's start with business at an early stage. And at this stage, the most important things that you need to pay attention to is maximizing awareness of your business among your target population of shoppers, and maximizing the distribution of your products or services. And here, so-called principle more is better comes into play. It means while building awareness, you have, let's say, 100% of shoppers that you want to target. And then you start increasing these numbers. And 10% of your target population being aware of your brand is much better than 5% of the population. So you keep on investing in advertising until 20% of the target population are aware, then 30, 50, 60, etc. And then you start noticing that actually every next dollar spent on advertising yields you less and less uplift, because it becomes extremely difficult to get from 85% of awareness to 90% of awareness, and from 90% to 95%, even a more challenging task. You have to have large advertising budgets like P&G, for example, to let everyone in a town or in a country know about how great your product is, so that they memorize the name. The same works for availability. Well, say you have 100 stores and you distribute a certain product in 90 of these stores. It means that chances of buying of this product are 90% at this level. But then let's say you want to increase this number, so you start opening new stores and you increase chances of shoppers actually popping inside and buying this product. And also you make sure that your product is distributed to 100% of your open stores. So the more stores handling a certain products you have, higher chances are that each and every shopper in your target population will actually buy it. And again, after a certain moment in time, opening new stores becomes more and more difficult because you pretty much cover all the areas with dense traffic and the major cities. And then you start thinking about some other drivers that are not so obvious. And here the relevance comes into play. And unlike the availability and awareness, they have a different principle of growing business. So instead of the more the better, optimal is better principle comes into play. And it means that, well, for example, you cannot say that the higher prices are the better, because too high prices can actually repel shoppers and they will stop buying your product. On the other hand, you also cannot tell, like with the case of costs, that the lower the prices are, the better, because you need to have certain profit margin when you trade. You cannot trade with a negative margin because it doesn't make sense at all. So when you offer shoppers to low prices, well, there are much more shoppers targeting your shops or your website, but you stop earning money on these transactions, and this is bad for your business. So there are a couple of pricing, but also non-pricing factors that play in this field of relevance. So let's start with the pricing factors. First of all, a business needs to make sure that they are present in major price segments. So if you are a label of super premium stores, that's fine. But if you want to grow at some point, you need to decide whether you want to expand and open another label of stores, for example, in mass market segment, or even further down in economy segment. You can take Ukrainian Fuzzy Group as an example. They have a broad range of labels covering all price segments that you can imagine. They have Silpo that covers mass market. They have Le Silpo that covers the premium and upper premium price segment of shoppers. They have Fora that covers economy segment, and finally they have Trash and actually Fuzzy themselves that covers the most price sensitive segments of shoppers. Then secondly, you need to have affordable prices overall. And that means that these prices need to be just right. As I said, the principle optimal is better works here. So it means that the price points that you have need to be perceived as affordable or fair or optimal in the eyes of shoppers. And this is a real art and science of pricing to identify what affordable prices means. Also, it's important to have correct price positioning, let's say versus your direct competitors, but also versus other industries or in retail that you are indirectly impacted, for example, during the times like this. And of course, there's plenty of non-price drivers in the relevance block. For example, assortment, which also has this rule: optimal is better, because you cannot really handle millions of products if you are an offline retail, even a hypermarket. So you need to keep the assortment within a reasonable range. But also, if you handle too few products, it means that you become irrelevant to a large share of all shoppers in the population, and you don't cover their needs. And it means that you are not winning these transactions that you could have won otherwise if you had the relevant range in place. So if we look at these drivers on the time continuum, it becomes this continuous so-called value equation management. When you start with exponential growth and you primarily invest in the drivers that have this principle of more is better, so you invest in advertising, you invest in distribution, and every dollar invested here gives you a nice yield. But then, as I mentioned, after a certain period, you hit a plateau, and here you start tuning and tweaking the drivers that need to be optimal. So here you start thinking about optimal pricing and assortment optimization. And typically at this stage, retailers start thinking about purchasing products like competitors, because it's, as I said, a real art and science. And typically retailers don't have analytical resources available to analyze and to produce this optimal pricing and optimal assortment strategy. So they really need this software that can make these optimizations for them, and that can analyze and process millions and billions of data points to help them implement the strategy. But then after initial tweaking of prices and assortment, they start reaching another plateau when they just realize that their prices are pretty much optimal and their assortment is pretty much optimal as well. This stage is typical for mature price leaders in retail who have invested in price and assortment optimization software, but also demand forecasting and logistics optimization software, let's say 5 or 10 years ago. So it means that they need to seek for further business growth drivers. And here they typically realize that there are ways to decrease price elasticity. And it means that, well, currently I'm price elastic and I cannot really increase prices anymore. But what if I invest in my brand image? Or what if I invest in the level of service? Can I invest in free delivery or some other customer experience for which customers are ready to pay an extra dollar or two? And then after you make all these investments, you think about increasing prices a little bit because you've spent things and you need to get the return on this investment. And here again, you start modeling and looking for optimal price points that would be higher than before the investment in a brand image. So actually, I think many of you have already heard from me or have read this information in the pricing course that is available in Computera Academy. But for those who haven't, I hope this information was useful and is still useful, because these three things just don't change during any crisis times. It's just that they start playing in a little bit different way, and also the focuses change a little bit. So when a crisis hits, the ability to supply the needed amount of certain product becomes the main challenge for the business. So the demand for certain categories that you can call essential actually soars, and it can increases by 3, 4, 10 times. So the main challenge is to have sustainable sources of supply, because your suppliers can't really predict that they would need to increase the production capacities by several times, and they are not ready for this. So pretty quickly there appears a shortage of certain products. For example, it can be toilet paper, or it can be soap, etc. For example, if we take Germany, drastic changes in the demand landscape have happened there in the past weeks. The sales of soap have grown 4 times compared to the pre-corona times. And sales of pasta and canned tomatoes and tomato sauces have grown 3 times. And it means that suppliers of these products are under a huge pressure. Also, given that they have to reduce the risk of corona contamination in their production facilities as well. So this is just to emphasize that availability becomes by far the most important driver of business growth or sustainability in the times when crises like the corona ones hit. But it does not mean at all that relevance becomes irrelevant. It is still relevant, and it is shaping and reshaping total categories and total industries. So what happens is actually essential categories like the ones that I have just mentioned start booming, and non-essential categories blast. Examples of non-essential categories could be, well, let's say it's toys. Although Ukrainians claim that they are ready to spend any money on their children to pamper their kids, It's not the case because, for example, the sales of Lego went down so significantly that you can tell that they almost stopped, and even very deep discounts offered by different players in the market cannot help revive demand on this category. In consumer electronics, for example, it differs. For example, any gadgets and other appliances that help people establish a remote workplace are actually booming. So think about laptops and some connectors and accessories for them. On the other hand, other categories, for example, accessories for smartphones can suffer in these times because people just don't buy things that they used to buy for leisure when they had stable income. Then relative price attractiveness and so-called magic price points or price thresholds become really, really important. And we've already talked about the correct price positioning. Here it becomes really crucial to keep the correct price positioning, and we're going to talk about this at a later stage, as well as about price thresholds and how they work. But for now, let's get back to these three drivers and let's have a look at how exactly they impact sales. So instead of calling them in a vanilla way, like awareness, availability, and relevance, let's call them in a pragmatic and business-oriented way. So relevance means primarily pricing and assortment. Availability is distribution, so how you distribute the products, and awareness is all about how much money you spend on media. So every 1% of change in the price on average leads to a 3% change in sales. So on average, if we take some arbitrary 100 FMCG brands, if I increase the price on a certain SKU, on a certain brand by 1%, the volume will go down by 3%. And if I decrease the price, then the volume will go up by 3%. In terms of relative impact, it's the most significant driver among all the drivers that businesses have at hand. And this is why the problem that Computera is trying to solve, meaning fixing the broken price world, is so important. And that's why retailers are ready to pay for such a software that can help them get pricing right. Also, distribution is very important. And in every 1% change in distribution, you will get on average 0.7% change in sales. So if I, let's say, I have 99 stores, and then I want to increase this number to 100 stores, it means 1%, roughly 1% increase in distribution. It will result in the increase of sales in my label by 0.7%. On the other hand, if my product is distributed in 99% of stores, and I want to have this distributed in 100% of all open stores, sales of this product will increase by 0.7% on average. And finally, there is a very vague impact of advertising and media spend. On the one hand, if you look at the numbers in a direct way, it looks very weak, because if you increase your media spend by 1%, your sales on average will increase by 0.05%, which is, well, nothing. But on the other hand, think about this. If you have low investment in advertising, if you just let's say spend $2 million to advertise your label or your brand, and on average, your competitors spend 5 million, it means that you can increase your media spend by 150%. And then the uplift in sales on such big percentage changes will look pretty significant. Also, if you just stop investing in media at all, you will run on some sort of inertia, and and people, the shoppers will remember about your label or your brand for a certain time. But in a year after you switch off advertising, you will see sharp decline in sales because memories are fragile and people just don't remember about your brand anymore. They don't remember that they used to go to your stores, and they don't. They stop thinking. They stop considering you. You fall out of the consideration set. So although if measured directly, the media spend driver is the weakest among the three, it does not mean that it is the least important. It's just that even a bit harder to manage compared to pricing and assortment. This is the commercial triad in crisis times. So the first thing that we see is actually the investment in media becomes pretty irrelevant, because people start forming their consideration sets in an absolutely different way. And regardless of how much bucks you spend on advertising your brand or your label, people just don't pay attention to it anymore if you are a non-essential category retailer. They just prioritize in a much different way. So many brands actually stop spending on media during crisis times, and nothing really happens to their sales. But it's important, as I said, to get back to advertising once the sea is still again, because as I said, memories are fragile, and if you don't advertise a product for more than a year, the chances are very high that people just will just forget about you and stop buying whatsoever. And then in terms of distribution, although the impact itself stays at the same level, so you still get 0.7 uplift if you increase distribution by 1%. But the absolute impact becomes really different, and the numbers really soar, because you can have distribution volatility by tens of percents or even by hundreds of percent. So for example, let's say you have online channel, you have website that can do e-com, and you have 99 offline stores, and then corona comes, and there is lockdown, and all your 99 offline stores close. So it means that weighted by the sales, at once you lose about 80% of your distribution. So if you multiply 80% decrease by 0.7, you will get a double-digit decrease. So your sales will be cut by more than half. You can also imagine a product that quickly ran out of stock because of the of panic buying. It means that the distribution of this product can drop from 100% to 0% in weeks. And in this case, you will not lose 70% of your sales, you will lose 100% of your sales. Also, in terms of pricing, as I mentioned earlier, relative price relevance becomes more important than the absolute one. So, but it differs depending on the category that we're talking about. So let's think about essential categories. In essential categories, your relative price relevance versus competition becomes the most important driver of your sales. And I'm going to talk about how to address this a bit later. And in non-essential categories, or in so-called gray area categories, which are half essential, for example, consumer electronics, it becomes important how you price versus essential categories and some mandatory spend, for example, utilities. And this was pretty visible in Ukraine in 2014. So in the beginning, when utilities prices for utilities were kept at the same level, the sales of non-essential categories depended more on how they were priced against some essential categories. But when the costs of utilities for the population were increased by several times, it also became very important how the prices for non-essential categories looked like versus the money that were remaining in the budgets of Ukrainian families after paying for the utilities. So if we take essential categories, we see a strong growth of sales there. But then the decision-making tree will be like this. Shoppers will panic buy in the cheapest label first, then in the second cheapest, third cheapest, etc. And in non-essential categories, they will decide whether to buy or not this product at all, regardless of the label, depending on the inflation in this category. So, for example, if a non-essential category, the inflation is higher than in essential categories, they will refrain from purchasing these products. But if this is below the inflation in essential categories, then the chances are good that shoppers will decide to purchase from these categories. So in essential categories, this is the competition game, and in non-essential categories, it's just about the prices inflation game. So let's go to the next section then. Let's talk about pricing needs. These are the questions that a category manager typically asks herself or himself when they have a feeling or they are urged to do something with prices in their category. And as I said, there is a limited number of such needs, and we can describe them via just 5 questions. So in regular times, category managers and pricing managers ask them just these 5 questions. Well, of course, there are much more questions, but these are the major ones. And the size of the bubble roughly corresponds to the number of times that a category manager asks these questions in a typical week. One is how to find balance between scale and profitability. And it means that every category manager or every pricing manager, they always have this conflict of needing to grow the category, but also staying profitable. And they always find it difficult how to merge these two needs in a pricing action, in pricing tactics level. Also, many of them think about how to grab market share, especially in retailers who are not market leaders. They, of course, they want to become market leaders, and they think about how to seize market share from market leaders by running promos, running discounts, keeping everyday prices low. Then there are some more tactical questions like how do I get rid of old stock? For example, how do I get rid of the old season before the new season hits the shelves? And actually, it's more profitable for me to start selling new products. Also, how do I price these new products when they arrive? What's the first price that I need to offer shoppers that so that the rate of sales is at its maximum from day one of the sales? Also, there's a specific need in offsetting cost pushes, and cost pushes can come from different sources, but the main 2 sources are actually local currency devaluation, when all of a sudden all your imported products become more expensive because their cost just directly correlates with the exchange rate. And the second source is well, raw materials. When, I don't know, cocoa beans become more expensive or coffee beans become more expensive, or some rare metal becomes more expensive. You know, the vendors of chocolate, coffee, and consumer electronics just increase their list prices, and you need to reflect it somehow in your shelf prices and in retail prices, because you cannot just decrease margin, your own margin, and continue selling these products. It doesn't make sense for your CFO, and he will shortly come after you if you do this thing. But then when a serious crisis comes, the frequency of asking these questions changes somewhat, and 2 questions become much more acute compared to normal times. And the most important question becomes the one: how do I offset a cost push? Even for retailers who are not focused on imports, who are actually focused on local produce like ATB in Ukraine, they have to deal with this because in some categories where panic buying happens, the suppliers run out of stock quickly, and they need to produce much more of this product in the facilities that cannot handle so many workers. They have to also implement the social distancing, etc. So the suppliers start increasing list prices, and ATB have to respond. So that's why they have increased prices for vegetables, etc., because they cannot trade with a negative margin. They have to reflect the list price increases that they are facing from the suppliers of these products. So the main question here becomes, how do I offset a cost push? How do I increase prices in a way that I don't harm my demand? This becomes by far the most important question. How do I target the products that are less price elastic? How do I target the new price points that don't damage the demand drastically? What are the price thresholds that I need to be aware of, etc., etc. In some other categories that where panic buying doesn't happen, the non-essential ones, another kind of question appears: how do I get rid of the stock that is not selling anymore? Because I need to have a certain cash flow, and I cannot just freeze this working capital in the products that I have purchased a month ago and I cannot sell anymore. So here the opposite question arises: how do I run discounts, and how do I decrease prices in a way that I'm able to sell these products still, but so that I have cash flow at a good level so that I can replenish stock in some other categories or in some other segments where the demand is stable or is growing. And then all other price related questions like how do I balance between scale and profitability, how do I grab market share, and how do I price new products becomes somewhat secondary, because first of all, you need to fix the cost pushes and the old stock questions in order to be able to have the working capital to stay afloat. So we started talking about relative price relevance. And let me give you an example of how relative price relevance works in an essential category. And as you probably remember, I was mentioning that in essential categories, the competition game becomes more important. And in currency devaluation and high inflation that follows, in these conditions, it becomes the price increase delaying game in the first place, meaning that you need to refrain from price increases as much as possible and do it as late as possible to have this 2 or 3 month gap from the competitors who have increased prices, so that you can grab your market share. But at the same time, you have to keep in mind that at some point in time you will have to increase prices. So this is all about calendarization. On this chart, you can have a look at how Mars implemented their pricing strategy back in 2014 and what result they obtained. So on the left side, you can see an average price per kilogram versus a year ago. And these are, well, actually Mars is a bit strange company. Probably they are Martians, because instead of having 12 months, they have 13 periods, because periods are more stable than months. They have the same number of days in each of them. But never mind. So you on the left, you can have a look at how the average price per kilogram evolved during 2014. And on the right, you can have a look at how their market share in volume terms has evolved in the same 2014. Here you can see that in the beginning of the year, the prices were pretty much stable, but then starting from February or March, Mondelez have started increasing prices, and immediately they started losing the volume share. So they kept on doing this, and they were actually ahead of all other competitions in the second half of the year in terms of price increases. And see how much volume share they have lost this way. Well, actually, Ferrero have followed their pattern, but at some point in time, they realized that they are overdoing it and decreased prices a little bit. So their volume share during the year was pretty much stable. It decreased a little bit, but not too significantly. But please have a look at Mars and Nestle. These two smart guys have decided to just wait and to lose some profit, but to delay price increases as much as possible. And they just followed Ferrero with some delay, and Mondelez with some delay, and both of them have gained the market share significantly. So Mars, in the end, was able to increase prices by 45% in the end of 2014. But at the same time, it gained almost 1% of volume share in the same year, which was, I think, amazing. So this is a delay price increase game. So in the previous slide, the picture was pretty much clear. The competitors were the same for years, and they haven't changed even during the 2014-2015 crisis times. But think about a situation when you have new competition during a crisis time, or you don't know, or you actually don't know who your competitors are. This can be the case in some e-com when they have hundreds of websites or hundreds of sellers on some marketplace that potentially have sales impact on their sales via their pricing action. Also, think about a situation with offline retail closure, like in Ukraine. Can you imagine how the online competitive landscape is being reshaped, given that all the offline retailers who weren't present in e-com are trying to enter the e-com with all the urgency appropriate in this situation. So it means that if you're an established player in online, well, first of all, you already have dozens of potential competitors, but also new strong offline retailers enter the field and become your new competitors. And it becomes a very difficult question to answer. Whom should I delay my price increases to? Whom should I follow? It's so unclear. So this is why it's so important to scientifically know who your true competitors are. And here you can see an example of our amazing true competitors tool. So this analysis actually can show you which competitors among the ones that you monitor put pressure on your sales by keeping their prices lower than yours, and which ones you can just disregard. So knowing these things can make decision making in your pricing so much easier, and you can respond to market action so much faster, which actually helps you to save both the market share and the profitability. So now let's get to another important pricing driver during crisis times, which is absolute price points. And some companies, they're so important that some companies even call them magic price points. I will explain shortly what this means and how they work. So if you run a simple analysis, of any category. If you put prices of SKUs on x-axis and you sort them by prices, and then you put their sales value on y-axis, and you can actually see that in a category there are different price segments, and they have peaks and dips that can help us draw price thresholds between them. So if we take a chocolate category, for example, there's three up to 7 price segments, and they're very clear. And the way it works that if you are a, let's say, a standard chocolate bar, you cannot really have a price point of a large chocolate bar, because people won't just see enough value in a product and won't buy it. So before the 2014 crisis, the price threshold for a standard Snickers bar was 5 hryvnias. So if a certain retailer would attempt to sell Snickers, at a higher price, they wouldn't just be able to sell it, because shoppers just knew that a fair price for standard Snickers was 4.95 or 4.99. But then for Snickers Super, the price threshold was around 10 hryvnias, because, well, it's big, it really satisfies the hunger, it can replace a whole meal. So that's why people were ready to pay twice as much for a large chocolate bar, but they were not ready at all to pay more than 10 hryvnias for it. And then it goes on and on and on. For chocolate boxes, they were ready to pay up to 35 hryvnias. For bulk, they were ready to pay up to 50 hryvnias per kilogram, etc., etc. And then, you have to know this price threshold even in stable times. And when it's not necessary, you should not violate them, because the reaction of demand when you cross a price threshold can be unpredictable. So in some other categories, it can be expressed in different orders. For example, in consumer electronics, if we talk about accessories, the round price points would lay at 100 hryvnias, 200 hryvnias, 500 hryvnias. For small appliances, the magic price point would apparently be at 500 hryvnias and 1,000 hryvnias. So for products that sell just below these price points, in normal times, they should not cross these thresholds. So this is how price thresholds and magic price points work in regular times. In the times of crisis, though, the vendors and the retailers have to start increasing prices. So this objective landscape, that is actually just prices, starts shifting. So we can see all SKUs moving in the direction of the right corner, because everyone starts increasing prices. But then the demand starts dropping, because shoppers have this inertia that lasts for 3 to 6 months. And let's say if you asked a random shopper in Ukraine about a fair price for sneakers a month after devaluation, they would say, it's 5 hryvnias. I wouldn't pay more than 5 hryvnias for it. In 2 months, I would not pay more than 5 hryvnias for it. Although in several months it already costs above 10 hryvnias, shoppers still were saying that 5 hryvnias is a fair price for it. So it takes shoppers from 3 to 6 months to adjust to new price points during the high inflation times. And you need to keep this in mind, because, and this is why, among other things, the delay of price increases works so well, because people remember the prices for the products that they buy often, and they don't want to give them up. They still want to pay this bloody 5 hryvnias for a Snickers bar for months after it became more expensive. But with the time passing, shoppers start adjusting to new price points, because when they see all products becoming more expensive, they say, well, okay, I mean, now everything is twice as expensive as it used to be. And they start building these new price thresholds in their minds gradually. So how do you know where the new price thresholds are? It's very, very difficult because you actually don't have historical sales to judge, and because the prices have never been at such high levels in the past, and you cannot really estimate which thresholds in the future you should not cross. So this is where shopper research becomes of help. There's a specific type of consumer and shopper research that I really like, that works very, very well in devaluation and high inflation times. It demonstrates you clearly where your price thresholds from the future actually are, because it's only shoppers who can tell you where they are. And you just ask them four very simple questions, and you immediately get information about how many shoppers you're going to lose if you cross each next price threshold. I will explain you now how this chart works. Here are the cumulative statistics. So there are four questions. Which price for this product would be so low that you would suspect bad quality and you wouldn't buy it? And this refers to the orange line of too low price. The next question is, which price for this product you think would be low, but you would still buy it because you wouldn't have any doubts about quality? And this is the purple line on the chart. The third question is, which price for this product would be high, but you would still be able to buy it? And this is the blue line on the chart. And finally, the red line is the question, which price for this product will be so high that you will refrain from buying it? And then you just collect the responses from, let's say, 300 people, and you put four cumulative charts on the slide. One of them is, two of them is reversed. So let's say, what is the percentage of buyers who said that the price of 3 hryvnias is low and too low? It is 100% of buyers. So which percent of buyers start thinking that only 10 hryvnias would be too low price, etc., etc. So for the low lines, at some point you get down to 0 responses. So none of the respondents think that 50 hryvnias is too low price, because the fair price is around 20 hryvnias. And for the high prices, for the two lines, the blue and the red ones, it's vice versa. Just 1% of respondents say that 15 hryvnias is high price. Well, it's not high at all, it's low. But then the number of shoppers with the price increases becomes higher and higher and higher. And at some point, there's this abrupt growth of shoppers who consider a certain price for the product too high and will refrain from buying it. So for this product on the chart, the current price was 20, if I'm not mistaken, it was 22, around 22 hryvnias. Okay, so for 22 hryvnias, just 1% of respondents said that this price is too high. But then, if it costed 25 hryvnias, 10% of shoppers would say that the price is too high and they will refrain from buying it. So you can assume that if you increase the price from 22 hryvnias to 25 hryvnias, you will immediately lose up to 10% of your shoppers. And then if you increase the price even further, you will keep losing and losing shoppers until you get to the price point of 30 hryvnias. So if you increase the price from 22 to 30 hryvnias, you will lose a half of your shoppers. And if you do it at 35 hryvnias, you will lose 65% or even 70% of your shoppers, etc., etc. So this kind of research demonstrates you where these price thresholds are. And most typically, the price thresholds actually lie on round price points like 25 grivnas, 30 grivnas, and in other categories, it could be 500 grivnas, 1,000 grivnas, etc., etc. So this research is rather inexpensive, but still I would act based on a Pareto principle. I would pick, you know, a handful of products that have the highest share in my sales, and would do this research on these products. And this will mean that I will be covered with the most significant products. But also, typically in retail, if you there are so-called anchor items. So if I know the price thresholds for anchor items, I will reprice them, and then by some rule, I will reprice all other products because their relative price is typically tied to anchor products. For the price thresholds in stable times, as I said, even a structural analysis like this works. So you can test your hypothesis of whether there's products of the same cluster residing within some price intervals, and then to identify these intervals. So for example, if our embedding classifies all boxes in a certain segment, we just need to check what the price interval that these boxes have sales within, and where the peak sales are, and where the sales of boxes are very low and stop whatsoever, and whether this price interval overlap with other clusters. And that's how you typically learn where the price thresholds of your product segments are. But in the times when price changes very fast, this market structure, the underlying market structure, becomes broken, and it doesn't get fixed for a couple of months actually, until everyone increases prices, and then you are able to see a clear market structure, the pricing structure of a category again. But I mean, for the future, if you have to increase prices by 100%, you know, there's no way to tell you where this new price threshold will be, because you never had such high prices for your products. For marketing, they need all four lines, because the cross sections of these lines also tell you some things about optimal prices. For example, the interval between the crossing of blue and orange, and between the crossing of purple and red line, this interval is considered optimal price interval. And this crossing of orange and red line, it means also the single optimal price point that you want to have, if you want to have them at the optimal level. Although, you know, I don't believe much in whether shoppers can really tell you what optimal price is in very volatile conditions, but they are very good at telling you at which price point they will stop telling your product. They don't lie. Okay, now let me sum it up, because I think we're rapidly approaching the end of the training. But just to sum it up, just let me reassure you that pricing was the king and is king in any times. It's just the focus is becomes different in crisis times. Also, times can be unpredictable, but retail will remain retail. They will not disappear into the thin air, and some retailers will go bankrupt, but there will be brave new ones that will take their place, and they will do pricing in the most efficient way. I have a piece of advice to retailers, and I hope we can convey it to them. You have to know who your enemies are, and you have to be smarter than them. So in our case, you have to be a little bit slower than them in increasing prices, but you need to know whom to follow with price increases. And Competara can help retailers know who their real enemies are. Also, it's legit in these times to use some magic, for example, to pay attention to magic price points and not to cross them unnecessarily. And of course, they can become, if they continue or start using computer pricing platform with a plethora of market-driven pricing features and cool ML features that can help them navigate even through the most volatile of times. That's it for my part. Thank you guys. Have a great weekend. See you next week.